In 2024, the financial picture for millions of Americans has become shockingly dire. More people than ever are on the brink of financial collapse, while countless others are just barely getting by. If you felt like your money doesn't go as far as it used to, you're not alone. In fact, the dollar has lost a massive 95% of its purchasing power since the 1970s. But recently, that decline has been accelerating, and people are feeling it in their everyday lives. Bills are piling up faster than income can keep up. Debt levels are hitting new highs, and many people are watching their savings disappear, leading to an increasingly fragile financial situation for the country. Today, we're diving into 12 key indicators that paint a concerning picture of the U.S. economy, and you may be surprised at how similar things feel to the economic downturn leading up to the Great Recession. With rising living costs and access to credit tightening, it's a tough reality for everyday Americans. But before we dive in, I want to take a moment to encourage you to like this video and subscribe to our channel. Your support not only helps our community grow, but also signals to YouTube that this content is important. Every like and subscription boosts our visibility and helps us reach more people who need to hear these vital messages. So if you find this topic resonates with you, please show your support. Now let's dive into these eye-opening statistics to better understand the challenges many people face today. 1. Rising energy bills are adding to financial strain. The surge in energy costs is another burden affecting American households. According to recent data, energy prices have risen by 4.3%, prompting concerns among consumers. A survey conducted by Kenneth Money found that 78% of Americans worry about affording their utility bills, and for 32% of respondents, this concern is serious enough to lead them to seek loans or assistance. Rising energy costs mean families must allocate more of their budgets to keep their homes comfortable and functional. Imagine a household that previously spent $150 a month on energy bills, now facing a $210 bill due to rising prices. This increase may not seem substantial, but for families already stretched thin, it can make a significant difference. As families cut back on spending elsewhere to accommodate rising utility costs, it often leads to difficult choices. Should they skip a meal to afford the energy bill? Should they forego necessary repairs or maintenance? These tough decisions can create stress and anxiety that impact both mental health and family dynamics. 2. Credit scores are dropping for the first time in over a decade. The rising levels of debt and delinquencies have led to a concerning decline in credit scores across the U.S. For the first time in more than 10 years, the average credit score has started to drop. This decline is significant because credit scores determine an individual's ability to secure loans, rent apartments, and even find employment in some cases. A declining credit score can have lasting repercussions. For example, if a family score falls from 720 to 680, they may suddenly find themselves paying higher interest rates on loans, which compounds their financial struggles. Lower scores can also make it difficult to qualify for essential services, like utilities or housing, pushing families into precarious situations. It's important to understand that credit scores don't just reflect an individual's financial history, they are an indicator of financial health. When scores drop, it often signals that many people are facing serious challenges in managing their debts, which can lead to long-term financial consequences. 3. More people are relying on borrowing to meet basic needs. As incomes dwindle, a concerning trend is emerging. More people are resorting to borrowing to cover their essential expenses. Recent surveys indicate that approximately 66% of U.S. adults are using credit cards or loans to meet their daily needs. Even among those earning over $75,000 a year, 41% report relying on some form of borrowing. This shift has profound implications. When families start borrowing to pay for necessities like groceries or utilities, it suggests that their financial situations have become precarious. For example, consider a couple who previously managed their household budget effectively, but now finds that their salaries barely cover their mortgage and utility bills. They might resort to using credit cards for groceries, leading to growing debt. This reliance on borrowing can create a vicious cycle. Not only do families incur interest on their borrowed amounts, but they also risk falling into a pattern of debt that becomes increasingly difficult to manage. The stress of mounting debt can impact not just finances, but mental health, leading to anxiety and frustration. 4. Housing market demand is fading. Now let's shift our focus to the housing market. The housing market is witnessing a decline in demand, with a growing number of potential buyers pulling back. Many families, discouraged by high prices and increasing interest rates, are choosing to wait before entering the market. Data from the National Association of Realtors reveals that home sales have dropped by 14% compared to the previous year. This decline in demand may seem like a temporary reprieve for those looking to buy, but it also signals broader economic concerns. As fewer people enter the housing market, property values may stagnate or even decline, impacting homeowners' equity. For example, a homeowner who purchased their property for $300,000 may find that its value has dipped to $280,000, resulting in a loss of equity that complicates their financial situation. Additionally, as demand decreases, it could lead to a slowdown in new construction, which could affect employment in the construction sector and related industries. The interconnectedness of the housing market with the overall economy means that any changes can have wide-ranging effects. 5. Credit card debt levels are reaching record highs. Next, let's examine the significant rise in credit card debt, which has reached record highs in 2024. The average American now carries around $8,674 in credit card debt, adding up to a staggering national total of $1.14 trillion. This escalation is largely driven by increasing costs and inflation. For many, credit cards have become a necessary tool for managing everyday expenses. But as families accumulate debt, the consequences can be dire. Picture a young professional who frequently uses their credit card for groceries and unexpected car repairs. While it might seem manageable initially, the debt can grow rapidly, especially with high interest rates. What's particularly troubling is that many consumers are unaware of how quickly interest accumulates. A person who borrows $2,000 on a credit card with a 20% interest rate could end up paying nearly $400 in interest over a year, assuming only the minimum payment is made. This burden can become a significant hurdle in achieving long-term financial goals, like saving for a home or retirement. 6. Household incomes have dropped by nearly 10% over 4 years. To kick things off, let's take a closer look at the alarming decline in household incomes. Over the past 4 years, U.S. households have seen an almost 10% drop in their earnings when adjusted for inflation. This isn't just a statistic. It represents real struggles for families trying to make ends meet. In April 2020, the median household income was about $67,500. But adjusted for inflation, it has fallen to around $61,000 today. So, what caused this decline? A confluence of factors contributes to this trend, including wage stagnation, rising taxes, and of course inflation. As the cost of living increases, families find themselves with less purchasing power. Imagine a family that used to comfortably manage their monthly expenses on a $5,000 monthly income. Now, with a 10% reduction, they're left with $4,500. But their expenses have risen significantly due to inflation. This situation forces them to rethink their budget, cut back on discretionary spending, or even dip into savings to cover their needs. It's not just numbers on a spreadsheet. It's the reality of many families, affecting their quality of life and financial stability. 7. Credit card interest rates are skyrocketing. Along with rising debt levels, we must address the staggering interest rates that accompany credit card use. Currently, the average credit card interest rate stands at 22.76%. This increase makes borrowing more expensive than ever, amplifying the challenges faced by consumers. When people can't pay off their credit cards in full each month, the interest begins to compound. For instance, a family with a balance of $5,000 could incur $1,135 in interest over a year if they only make the minimum payments. This situation often results in individuals being trapped in a cycle of debt that seems impossible to escape. Moreover, high interest rates disproportionately affect lower income households, which often rely more heavily on credit to manage their finances. As interest rates rise, the burden becomes even heavier, leaving families with less disposable income and limiting their ability to save or invest for the future. 8. Banks are reporting record losses due to rising delinquencies. As credit card debt accumulates, it's no surprise that banks are reporting rising losses due to delinquent accounts. Recent data from the FDIC reveals that delinquency rates have climbed to 10.9%, the highest in over a decade. This rise signals a troubling trend that affects not only individuals but also the broader banking system. When banks absorb billions in charge-offs due to unpaid debts, it has ripple effects throughout the economy. For instance, major banks like JP Morgan and Bank of America reported losses exceeding $5 billion in charge-offs just for the second quarter of 2024. This situation could lead to tighter lending standards, making it more challenging for individuals to secure loans or credit when they need it most. Additionally, the increase in delinquencies often reflects a deeper economic issue. Many families are struggling to keep up with their monthly payments, which can lead to broader financial instability. This instability can result in more people facing eviction, foreclosure, or bankruptcy, further exacerbating the economic crisis. 9. Mortgage payments have skyrocketed by 96% since 2020. Let's shift our focus to the housing market, where mortgage payments have skyrocketed by a staggering 96% since 2020. The average monthly mortgage payment now hovers around $2,065 compared to $1,329 just 4 years ago. This increase is largely attributed to rising property values and higher interest rates, which have made homeownership less attainable for many families. For first-time home buyers, these escalating costs can be particularly daunting. With home prices continuing to rise, it's increasingly challenging for families to save for a down payment. Consider a couple who planned to buy their first home, but found that what was once an achievable goal has now turned into a distant dream. They might be forced to rent longer than they anticipated, delaying their plans for building equity and a stable future. Moreover, for existing homeowners, rising mortgage costs mean that a greater percentage of their income is tied up in housing expenses. As more of their monthly budget is consumed by mortgage payments, families have less available for savings, investments, or discretionary spending. This trend can lead to a greater strain on family finances and limit opportunities for financial growth. 10. Many are delaying major life decisions. The financial pressures of today are influencing life decisions in profound ways. A survey by CNBC revealed that 62% of Americans are postponing major life milestones, such as buying a home, starting a family, or retiring early. The stress of managing financial uncertainty can lead to significant lifestyle changes and missed opportunities. Delaying major life decisions can have long-lasting effects. For example, a couple may decide to put off having children because they fear they won't be able to afford childcare expenses or college savings. As time goes on, these decisions can lead to regrets or feelings of being stuck in a financial rut. The ripple effect of these delayed decisions can extend beyond individual lives. For instance, when people hold off on purchasing homes, it can contribute to a slowdown in the housing market, impacting construction jobs and the economy as a whole. The interplay between personal choices and broader economic trends highlights the challenges faced by many in today's financial landscape. 11th, student loan debt is reaching crisis levels. One of the most pressing issues today is the staggering level of student loan debt, which has surpassed $1.7 trillion, impacting approximately 43 million Americans. For many, the decision to pursue higher education is a significant investment, but the resulting debt can become a burden that stifles financial progress. The average monthly payment for federal student loans is now around $400, which can pose a significant challenge for recent graduates. With wages not keeping pace with the rising cost of living, many graduates find themselves caught in a cycle of debt that prevents them from saving for the future. Consider a recent graduate who enters the job market excited about a new degree but quickly realizes that their starting salary isn't enough to cover both rent and student loan payments. As a result, they may have to defer other financial goals such as saving for a home or retirement. This struggle highlights the broader issue of how educational costs can hinder long-term financial stability and lead to delayed life milestones. 12. Financial anxiety is at an all-time high. Finally, let's discuss the emotional toll that financial pressures have created. Financial anxiety is now a significant issue, with studies showing that over 60% of Americans report feeling stressed about their finances. This anxiety is linked not only to day-to-day living, but also to long-term goals, like saving for retirement or funding education for children. This heightened state of financial anxiety can lead to a host of mental health issues, including anxiety and depression, affecting relationships and overall well-being. When individuals feel trapped by financial burdens, it can create a cycle of stress that impacts every aspect of their lives. Managing finances becomes not just a challenge of budgeting, but an emotional struggle that can lead to chronic stress. Consider a parent who constantly worries about paying bills and saving for their children's education. This anxiety can impact their mental health, leading to sleepless nights and difficulty focusing at work. It can also strain relationships, as financial stress is a common source of conflict between partners. In conclusion, it's evident that financial hardship is a pressing issue affecting millions of Americans. From declining incomes and surging debt to rising costs of living and the emotional toll of financial anxiety, the signs are clear. People are struggling, but what does this mean for the future? Understanding these issues is the first step toward finding solutions. Financial education, support, and planning are more crucial than ever. Whether it's budgeting more effectively, seeking financial advice, or simply having open conversations about money, we can begin to address these pressing issues and work toward a more secure financial future. It's important to remember that you're not alone in facing these challenges. Many are navigating similar struggles, and it's essential to reach out for help and support. By fostering open discussions about finances and advocating for financial literacy, we can collectively work toward a more stable and secure future for ourselves and our families. Thank you for joining me in this exploration of the financial pressures facing Americans today. If you found this discussion valuable, please take a moment to like this video and subscribe to our channel. Your support is vital for our growth and helps ensure these important topics reach more people. And don't forget to share your thoughts in the comments below. I'd love to hear your experiences and insights. Let's keep this conversation going. Until next time.